For everybody here, we'll be able to send out the recording afterwards. So thank you all for joining. My name is Cody Pronto. I'm head of sales here at Entendre Finance. We are a Web3 subledger and general ledger. With that, what we are going to be doing today is we have the fantastic Nick from Harris Trotter, the digital assets manager, going to talk us through not only closing the books as a crypto accountant, but also some of the new FASB guidance. I'll let Nick introduce himself and take it away. After that, just a few quick things. We are also going to be doing a Q&A at the end if you have any questions around best practices. And then again, at the end, if you have any types of webinar content that you want to know more about, please don't hesitate to reach out. We are going to be doing a monthly webinar series, and we want to make sure that this is impactful for our attendees. Well, with that said, I will pass it over to Nick, and we'll get started.
All right, thank you, Cody. Yeah, so like Cody said, I'm Nick. I'm one of the managers at Harris Trotter within the digital asset space. So I'm a chartered accountant, qualified at PwC within London in the UK, and made the move over to Harris Trotter just over a year ago. So yeah, we'll be discussing the life almost of as a crypto accountant, the challenges of closing the books. Yeah, so I've kind of just wanted to narrow it down into quick intro about ourselves. Discussing the crypto landscape, what's different about the crypto landscape to the traditional landscape, and why that creates challenges, specifically within the accounting profession. And then, I just wanted to give a rundown of the process that we tend to follow to try and streamline this as much as possible. And then, as Cody mentioned, we'll have a Q&A session at the end for those interested. So, quick background about us, Harris Trotter. We are not a startup, unlike the majority of other firms in this space. We are a firm of accountants based in London in the UK. We've been around for 80 or so odd years. But in 2017, we took on our first crypto client, and we've since then have become an international industry leader within the crypto blockchain space, and provide anything from audit, accounting, advisory, bookkeeping, and tax services, as well as on and off ramping assistance. So whilst we are based in the UK and the majority of us are sort of chartered accountants from the UK or trained within the UK, we do have a global reach because we are part of what's called BKR International, which is the 7th largest accountancy body in the world. So I'd say about 65% of our clients are actually overseas, where we kind of come in as the crypto specialists, do the majority of the crypto, bookkeeping, accounting, audit work, whatever. And then we have a partner in whatever jurisdiction needed to form the sort of statutory requirements, the sign-offs where necessary. So yeah, we've come a long way since 2017. We have about 400 to 500 crypto native clients now. Some of those include the likes of 1inch, Wintermute, blockchain.com, the Sandbox, Bitfury, Mercuria, P2P, just to name a few. So yeah, it has really been an exciting journey from where we started to where we are now. Anyway, enough about us. So let's talk about the crypto landscape and what's sort of new about it and why we need to care about that as accountants. So first point I just wanted to touch on is, decentralization is such a buzzword that's thrown around left, right, and center within the space, but it is fundamentally a completely new way of how transactions occur, right? So in the traditional space, you have your middleman often. In the Web3 space, that intermediary tends to be cut out, right? So what does that lead to? That leads to a lot of volatility in a lot of times, right? Which great for some of us investors, bad for some of us investors, especially bad for accountants, because we always like to, assign values, figures on the assets that we're reporting on, right? So when you have assets that are so volatile, which make, have fluctuations of 2x, 10x, 100x, how are you reporting on that value? So that's something that we tend to not really see in the traditional world as such. The next point I wanted to touch on is, we're seeing such sheer volumes of transactions within the crypto space for, even small companies with only finance teams of maybe 1 or 2 people. I'd say, I mean, we have clients with 5 to 10 transactions a day, anything up to 5 million transactions a day. So actually dealing with such large volumes of data doesn't only create problems from a technological perspective, because you need some sort of system to actually be able to handle all those transactions, but you also need to be able to actually be comfortable that you need to account for these transactions, and you need to be happy that those transactions are booked in properly as at your month end or your quarter end or your year end, right? So yeah, just completely new scales that we're seeing. Obviously, the Web3 space is very innovative, constant new evolutions, new technologies, that does impact, the accounting, the bookkeeping. So just something that we're seeing a lot of, and we need to be aware of. Now, following on to that, you do see, you have your crypto, which is, a lot of people think of the traditional cryptos, Bitcoin and ETH, right? They're very, very sort of straightforward, well-known assets, but you have, thousands, hundreds of thousands of new types of tokens, some of which have all sorts of use cases. And seeing one, you need to be able to recognize, okay, well, is there some underlying value? What really does this actually stand for, right? And that in itself creates all this diversity that we need to keep up with as accountants, and something that may not be as extreme in the traditional world. That examples, NFTs, right? A lot of people just think of, I don't know, a painting of an ape, but nowadays there's all sorts of different types of use cases for NFTs. DeFi, in itself, decentralized finance is a new concept. It can be very complicated. That's what we see across our clients. So yeah, just new topics that need to be considered for crypto accountants. And then the last point I just wanted to touch on is the sort of uncertainty that we're seeing. Obviously, those of you who are in the US, you've seen all sorts of ups and downs with the SEC, other jurisdictions as well. It's incredibly difficult to know where you're going to stand in a year, right? How are the tax implications changing, audit requirements, accounting standards? It's very hard to predict where things are moving to. So it's vital that we stay on top of the latest changes, and that we're actually well equipped and ready to adapt for whatever might happen, because these changes can come overnight, as we have seen before. Now, what are the actual challenges when closing the books? So I'd say the first instance that we need to consider is, as accountants generally, what we're trying to do, we're trying to translate raw data into a sort of readable financial format, right? You might have your shareholders, potential investors, banks, lenders, whatever, as a sort of, potential audience to understand what's going on with your company, or as an individual, you might have management reports, accounts. We now have that additional layer of complexity where, a company may be, having all sorts of crypto operations, but they may have a potential investor that doesn't understand the financial implications of all of these, or doesn't understand the technicalities. So we now need to make sure that our Web3 info is actually translated accordingly into a standard, set of financials that can be read by people with sort of basic literacy in the financial perspective, right? Now, how do we do that? Well, we need to make sure that we have that accurate and complete data set. Again, as I mentioned before, we're seeing such large volumes at times. We see a diversity of different transactions. So actually being able to record these accurately, ensuring that your crypto figures are reliable and are true to what's happening on chain or on your exchanges, is far from simple a lot of the time. So this is the second buzzword I'm going to throw out, or buzzwords, cost basis, which is a crypto accounting buzzword, as I like to say. But it is the basis of everything that you're doing, right? It's you're having to track it across your different assets, across your different wallets. It's what's going to tell you what your year-end value might be for crypto. You know, it determines your realized gains and losses that may be you know, taxable in whatever jurisdiction you may be. Very important to track, and by no means an easy feat. So yeah, it's something that you probably wouldn't have dealt with in the sort of traditional space as such. So very much a new concept for a lot of accountants. And the next point I wanted to touch on is you know, that it is almost accounting 101, right? Cash versus accruals basis. You learn that almost in your very first day of accounting. But what we tend to see is the amount of times we come across records from a Web3 company where they're dealing with transactions, or well, they're dealing with costs or expenses on a very transactional basis, right? You know, you might be seeing 5,000 USDC coming out on the 16th of November, and they're recording that cost as at the 15th of November, but it may actually relate to you know, some sort of work that was performed 2 months ago. So why is there that disparity all of a sudden? Well, one issue is that, you know, you have your traditional ERP systems, which a lot of people know how to use well, you know, your Xero, QuickBooks, but they don't have a suitability or a space for the crypto side, right? So that disconnect that we're seeing ends up, you know, creating issues, and we've seen whole accounts being based or being built just off cash accounting without anyone realizing, because people didn't think to apply their traditional accounting skills to crypto, right? But the same concept still applied. And now, yeah, the final point I just want to touch on, I kind of already discussed in the last slide a little bit, but just around NFTs and DeFi being a sort of, they tend to just be grouped elsewhere. NFTs, you know, like I said before, they have all sorts of different purposes nowadays. So, you know, is there a different intrinsic value based off underlying features? It's not just maybe the cost that you buy out, but, you know, if your NFT, I don't know, allows you to purchase a bit of real estate, for example, somewhere, you know, are you able to accurately value that? DeFi, yeah, just you got to be aware that, you know, you have your month-end positions, your accrued rewards, your permanent losses. Tracking that does tend to be incredibly difficult, and a lot of people don't do it correctly, unfortunately. So yeah, it is by no means an easy task. Now, how do we actually go about this? Okay, how do as crypto accountants, what do we need to do? What process do we need to follow? So I've put together a fairly generic, but, you know, a generic 3-step approach, but I think, like, more or less it should encompass what you need to do, right? So the first step is just about gathering your data. Just make sure that you have everything included that you need. And the second point, which is, you know, where most of the bulk of the work comes in, is actually tracking your transactions, making sure that, you know, you're accounting for them properly. And then the final stage is, once you've done those, converting that into that readable financial format that I discussed earlier, which is, you know, the purpose of our work so many times, right? So, okay, some of these may sound obvious, but, you know, regardless of whether or not they're obvious, doesn't always mean that they're being done. Okay, so the amount of times, you know, some of you may have been working in a crypto company and you think you have all wallets, and, you know, you might have a founder or the guy from the tech teams turning around saying, oh, by the way, here's 10 more wallets we created a year ago, and you've realized you've been missing thousands of transactions. So you've got to go back and redo all your work. So ideally, you know, we want to try and tackle this from day one. Ideally, you know, have maybe set up some internal controls, some way of governing the, you know, you keep track of when new wallets are founded, when new exchanges are being opened, accounts with exchanges are being opened, because yeah, if we don't have a complete data set, we're never going to have a picture of our crypto finances. So even if you do have your wallet addresses, have you actually, you know, considered them across all chains, you know, especially EVM chains, you might have an ETH wallet, but have you considered whether or not there's been any transactions on Polygon, on Gnosis? It's happened to us before where we thought we had all the transactions, but really there was a bridge over to, I think, Polygon or somewhere, and we realized there was just a few more transactions that we had to account for, and then we missed out. So yeah, it's just a sort of completeness perspective thing that we need to ensure. The third point is a bit more sort of directly related to centralized exchanges, and which is around the transaction retrieval, right? So on chain, it tends to be fairly straightforward. You can even go on block explorers and you can just always see, anyone can see what transactions have been happening, even if it's not your wallet, right? Centralized exchanges, maybe you're using software or you're having some, you've built a script, or you have some other way of pulling the data from the centralized exchanges APIs, right? And we do just almost always see issues with that, and we see transactions missing, and then that leads to negative balances, missing volumes. It's not like cryptos, it's not like having a bank account where you can just go into overdraft. If you've got a negative balance, it's going to be incorrect, and that kind of stuff will impact the cost basis, which will then impact your final figures, your gains and losses. So yeah, if you do have an API connection with a centralized exchange, maybe just worth just asking for a transaction report as well, and just doing a quick comparison, just to make sure that you're comfortable with the transaction retrieval. So yeah, step 2, like I said before, this is sort of where the bulk of the work goes in. How are you actually tracking your transactions? It's not always as straightforward. Obviously, some companies may only be using crypto to pay contractors or receive some of their payments, but others may be, entering liquidity pools, doing all sorts of swaps, DeFi, whatever. So how are you actually really tracking those transactions? How are you assigning, are you assigning labels to them? Are you making sure that, they have a proper chart of account mapping, because you ideally want every non-zero transaction you want to be a journal, right? Your gas fees, you need to make sure that you're tracking as well on the side. And how are you doing that? I think a lot of people that we work with, they started off by just using some massive Excel spreadsheet with, I don't know, 10, 20 different tabs. Becomes very manual, very lengthy, more error prone, I'd say, as well. So us at Harris Trotter, we're very technology driven. So we work with people like Cody. We work with other firms. We create our own products, because we're very much of the belief that in this space, automation is key. So as much as you can to deal with a large amount of data, you want to try and automate that so that you are low on the sort of error scale. Now, internal transfers are incredibly important to identify because they follow a slightly different accounting treatment, right? They're zero gain, zero loss. And you're transferring the cost basis over, rather than when you do an external deposit, you need to look at the difference between the fair value and the cost basis. So yeah, important that you identify those. The on and off ramping as well kind of feeds into what I was discussing earlier about the disparity that we're seeing between the ERP systems and the crypto subledger or the crypto accounting side, because you might be seeing the money come out of your bank account and then coming into your Kraken account, say, for example. When you combine everything into your books, you need to make sure that they're matched up appropriately, right? So it's something that you just need to keep track of. And then similarly, gains and losses I've already touched on, but yeah, massively important, especially if you're in a jurisdiction where those gains are taxable. Very important that you're keeping track of those accurately. Invoicing, like I mentioned before, just make sure that you're using the accruals basis. So if you're raising an invoice in, say, a Xero, a QuickBooks, and you're receiving that payment, are you able to match off that invoice, because you don't want to sync all your transactions into your ERP or however you do it, and then you forget to net off all your AP or your AR. We've seen that happen before. So it's just it is an additional complication just because of the limitation of these ERP softwares. and their lack of crypto functionalities, it can be a fairly lengthy task, but it's nonetheless important. And then yeah, last point just to touch on is, you may have entered into some sort of investments, SAFs, for example, simple agreements for future tokens. Just be aware that you are comfortable with how to account for those. Not just at the day of entering the contract, but also when these tokens do vest. Are you happy with what cost to record them at, and the ratio between vested and unvested tokens? Now, assuming we've done steps 1 and 2 correctly, then we go on to the final phase where we're, putting everything together, creating whatever financial report that we need. And yeah, just got to stress, as accountants, we always want to create a complete and accurate picture. And that is, assuming that we've followed steps 1 and 2, should be manageable. I think an important consideration that if it hasn't been done at this stage yet is actually where the crypto sits on your balance sheet. So I'd say the majority of companies probably tend to hold it more as intangible. But for those of you who might be buying and selling crypto as part of the ordinary course of business, market makers, exchanges, high frequency traders, inventory may be a more applicable standard to follow. Obviously, we've seen in America the FASB ruling around fair market value reporting. So that enables the additional feature of actually reporting your crypto at fair value. But it doesn't negate the tracking of the cost basis. I think some people seem to believe that, as long as you can report your crypto fair value, it means you can just ignore all other cost calculations. That's incorrect, because you still need to track your realized, your unrealized gains and losses. So yeah, nothing doesn't change anything from that aspect. Just be conscious that, have a reliable source for your market values for your crypto, because that's always important when you're acquiring new crypto, if you're doing a fair value revaluation, an impairment, or an upward revaluation. But yeah, assuming you've done all that, I think you're more or less in a position where you can close your books, and you should have a fairly accurate view of your crypto. And yeah, I'll leave it at that for now. I'll hand it over back to Cody.
Yeah, thank you so much, Nick. Really appreciate the time. And guys, this is a good moment to move into the Q&A. So if you have any questions, feel free to drop them into the Q&A bucket here. I'll kick one off. Hey, Nick, is there an optimal way to structure your wallet system to make crypto bookkeeping easier? I know here we have some clients that prefer to do it by asset. We have, others that do it, more so by individual wallets in like, say, QA and other, types of wallets. From your perspective, is there an optimal way to organize it?
Yeah, I mean, it's a good question. I think there is, because what we tend to aim towards is, getting your wallet hygiene in order early doors, because it makes life way easier than going 2 years down the line having to clean up everything historically. So I mean, it's really client dependent, but I personally always aim to have a sort of segregation by operations for your wallets, right? So you might have one wallet to pay your contractors. You might have one wallet which receives payments for your sales. You might have one wallet in which, you do random DeFi stuff. That then allows automations. You know that anything that enters wallet A is immediately going to be part of your a payment for your sales, and it makes the accounting way more straightforward. I also would, argue that what we see sometimes is people mixing their wallets. So, for example, a director or an owner might use some of the assets for their personal use and some for the company use. It always creates headaches for an accountant, because it becomes incredibly difficult to track. So, as much as possible, I would urge segregation. not just between ownership of company versus individual, but also, you know, within your different lines of operations. Because yeah, it may be more work at the beginning, but going forwards, it's gonna reduce lots of headache.
Yeah, no, that makes sense. And I think to that point too, if you're able to set up your wallets in a way that maybe you're always receiving payment in one and making payment in another, depending on the subledger, I know like with Entendre, we're able to automate rule sets to even handle the accounting based on wallet, right? So you can really, you kind of hypercharge your accounting function in your close process that way. Now, another question for you, what additional checks can be taken to ensure our final crypto figures are accurate?
Yeah, so I suppose there's two aspects, right? So if we start with the on-chain figures, right, your figures from your wallets. So we at Harris Trotter have an internal tool that we build ourselves, where we're basically calling a node, and we actually have a sort of, it's almost like a third-party verification of the balance as at a certain date. So we always use that as an internal way of double checking that you know, the volume that we've been recalculating using our current crypto system is correct, because what we're calling from the node, we just assume it's going to be accurate. Then I think the other aspect that we try and do is, well, on the centralized exchanges, you obviously can't do the same sort of technology, but you can actually obtain a balances report maybe from, you know, a Binance or Coinbase, and then that's almost like a third-party verification that you can use. The other sort of reconciliation that we try and do is where we do a recalculation of our journal amounts and then a recalculation of the volumes. And in theory, if those volumes or the cost that's being calculated should always match what we're calculating through the journals. And in theory, it should. It's just if it doesn't, it usually means that there's, I don't know, an incorrect journal somewhere, a missing journal. But yeah, there are additional checks, and you know, especially for those companies out there who are now facing audits, it's becoming more and more popular, not just by, you know, not just because of statutory requirements, but shareholders are wanting to see what's actually going on in their crypto companies and are demanding audits. So yeah, it's imperative that we do have that sort of traceability and those additional checks as a way to show that we're comfortable with those balances.
Yeah, no, that makes complete sense. And I know like one of the big things that I tend to hit home on, especially with Entendre, is the auditability, right? Like you want to be able to audit all of your transactions, whether it's just while you're doing your close or, to your point, if you're a DAO and everybody wants to know where the money's going, right? So guys, we are at time. I want to thank everybody for giving us, you know, 30 minutes of their day here. If you're interested in learning more about Harris Trotter and how, you know, they can help you close the books or any of their expertise, I'll make sure to send out a follow-up email with Nick and another point of contact there. Also, the website is at the bottom here. And similarly, if you're interested in a new subledger or even just seeing what's out there, feel free to go to Entendre, you know, request some time with us and we'll take it from there. But, you know, Nick, any closing thoughts on your end? Otherwise, you know, we'll end it and take it from there.
Yeah, no, happy to leave it at that. Thanks a lot, Cody. Appreciate that.
Of course. Well, thanks everybody. I'll be sending out the recording, and of course it'll be available on our website after the fact. Thanks so much for the time, and enjoy the rest of your Thursday.
Great. Thank you, everyone.
Bye.